If you're of the age of less than 45, I think you're gonna like this tutorial, because if you look at this survey done by AXA, 27% and 26% of Millennials and Gen Z prioritize financial independence at the top of their mind for a better life. But if you're age of 45 and above, don't switch off yet. Continue to share your story, share your experience, because we can all learn, and there will always be learning points when we discuss about this topic on financial independence. But let's flash back up this AXA study. What is surprising is that Gen X and baby boomers prioritize better health ahead of financial independence. Now that is startling and a good wake-up call. You know, I'm age 38 this year, and just to share with you, in my circle of friends on Facebook, I've seen a few with diabetes and cholesterol problems already. And how do I know that? That's because they shared it openly, that they are going on extreme exercise routines. And whenever they do that, I give a big thumbs up, because at least they are taking control back. At least they're not giving up. At least the wake-up call comes handy before it spirals out of control. But today's topic is about financial independence and 8 things you need to accomplish before the age of 45 if you want to go for FIRE, financial independence, retire early. So if this topic interests you, continue watching on. Hi guys, welcome back. Today I have 8 points for you, but these 8 points will be within this pyramid of how you're going to build up towards your own financial independence. At the base is health, and to be exact, good health. And the reason I'm not going to money topics first is because at the foundation of FIRE, financial independence, retire early, you need good health, correct? You don't want to be retired and sick. That is sad. That is not quality of life. If your health sucks, no matter how much money you have, really doesn't matter already. And that's the wisdom that those who are a bit older are sharing. They have seen health problems and they prioritize good health now ahead of purely money. How much is it going to cost if you are not healthy? Let me show you some findings. This is if you have type 2 diabetes. And type 2 diabetes is largely diet related and develops over time. So what is done in this study is they found out that on average annually in Singapore in 2018 is about $2,034. Something I boxed up for you. That means about $200 per month. And on a lifetime medical expense wise, if you are of the age of 40 with diabetes diagnosed already, it's $132,506. Wow. It reinforces, if you have medical needs, your lifestyle costs will just inflate. And that again is 2018. Right now, when you're viewing this, you have to inflate it definitely, correct? And if you are going to survive long with a medical condition, this number is definitely an underestimation. So good health cannot be understated. And in any case, you know Shield plans nowadays, medical insurance, there is a 5% co-payment, correct? Which means if you go for a surgery, there's $50,000. You're still out of pocket $2,500. And in retirement, every amount counts. If you spend $2,500 on surgeries here and there, you'll bleed your retirement pot unnecessarily. So again, stay healthy, do exercise more, that's the foundation. And with that, let's move on to point number 2, which is in the sustainable insurance cost column. Why do I rank this so highly? In any case, I'm a financial advisor and I have deeper insights into what you can do for yourself right now. The first thing about why I coin it sustainable insurance cost is because insurance costs right now when you are working, that few $1,000s per year, doesn't matter. But when you are no longer getting active income in, you tend to feel the pinch of insurance costs quite a lot more. That's why I see in older clients. In fact, across my whole team, I've heard a lot of feedback of elderlies cutting back on their medical insurance. And I just want to share with you that this is a thought process that you will also face when you get to older age. So when you plan your insurance portfolio, look at when your costs will start to tail off. Do you have whole life plans that are 25 years that need you to pay premium until 60? That doesn't quite make sense. It's much better to pay off whole life plans earlier. Limit the payment, maybe to 45 and before. Again, that's because every few $1,000s counts, especially when you're in retirement years. Then what about for medical insurance and long-term care insurance costs? Let's start with medical insurance first. Let me show you a table by Careshield. because Raffles Shield offers an intermediate option that I can illustrate a bit deeper. What you can see over here is Raffles Shield Private, which is the one that covers for all hospitals. At the age of 61 to 65, it requires you to pay $937 per year already in cash. That's the amount above the $600 in Medisave. That is pretty expensive, correct? And that amount will only escalate as you become older. Then Raffles has this special option where they allow you to go government hospitals plus Raffles Hospital, and it's called the Raffles Shield A with RH option. What you can see over there is that you need to still pay cash of $429 in addition to the $600 for Medisave if you want that plan. That is again at the age of 61 to 65. But if you choose to downgrade further, you just say I go only government restructured hospital. That's under the Raffles Shield A option. The cash outlay is now only $5, like a plate of chicken rice. Quite affordable, but you get my point. Especially at the older age, consider downgrading because you need sustainable medical insurance costs so that it doesn't impact your total expenses and you can afford it and not let those thoughts of letting the plan lapse get into you. So downgrading is always an option, especially if you become older. So do always know that at the back of your mind. And as always, premium rates are non-guaranteed. If you already have a shield plan, be careful about changing insurance because pre-existing conditions can become excluded. And then let's move on to point number 3, which is still in the sustainable insurance cost column. That is regarding upgrading your long-term care insurance. Why do you need to do this before the age of 45? That's because such insurance premium are based on your entry age. But again, we need to address how does this relate to financial independence, correct? When we think about financial independence, we cannot be naive and assume that we would stay healthy, not be hit by trauma. You got to plan for worst case scenario, correct? We know bad things happen. When I was much younger at the age of 20, I never believed that I would get any injuries, but myself, I've gotten an eye injury before, and I'm sure you have your fair share of stories. And just to share with you a few quick pointers on Careshield Life. Careshield Life premium increases every year. There's a difference between male and female in terms of premium rates, and there are actually options that you can use to upgrade your Careshield Life coverage. It starts with $600 for Careshield Life when you get a claim, but that barely covers maid costs. So you do need to consider upgrade, especially if you are serious about financial independence. Now let's look at an option by Aviva Singlife. You see over here that they have a table that once you input your age and gender, you can actually get options on what you can pay using fully Medisave. There are 2 plans that they carry, My Long Term Care and My Long Term Care Plus. My Long Term Care is with 3 out of 6 activities of daily living, ADL, for you to start claiming. My Long Term Care Plus is 2 out of 6 ADL, which means a slightly less severe condition, you can start receiving payouts. But as you can see, My Long Term Care, the suggested plan, allows you to claim $1,004, whereas My Long Term Care Plus, the payout benefit is only $1,002, which means slightly more expensive. That's why the monthly benefit was reduced. Again, this suggestion done by the platform is to show you if you fully want to pay by Medisave only and no cash required. Great Eastern and NTUC Income also hold plans, and the concept is the same. Upgrade it to ensure that if there is any disability, temporary or permanent, you get a cash payout to defray your living costs. And the key secret to how to make this sustainable is to ensure that you have enough money in your Medisave. This year, basic healthcare sum BHS is $66,000. And if Medisave pays 4% interest, you realize that that amount can easily sustain your medical insurance, your long-term care insurance, and your relevant upgrades. So as always, if you're serious about financial independence, make sure that your Medisave has enough buffer and interest can sustain such plans and that your insurance cost is sustainable. And with that, let's move on to point number 4, which is in a different quadrant, that is called clearing liabilities. In clearing liabilities, I've also a few key points to add for you. It starts with paying off your mortgage. I came across an interesting article. This retired couple was shocked to discover that 2/3 of their housing loan was still owed despite 20 years of repaying. The couple is based in Malaysia. The bank they took the loan from is also a Malaysian bank. The full reason is still unclear after reading the article, but what I can infer from it is that this couple was not even sure of their remaining loan. They didn't keep track all these years and they left it assuming that they have paid it off, which is not correct. When you get to financial independence, you need to make sure that your house is paid. Check on your mortgage bill. I'm sure Singapore banks are a lot easier in terms of how you can navigate the remaining amounts. And if you are some years away, start planning now how you can pay it off. That is why on this channel, I've always advocated, be prudent in how you purchase your home. Because if you take on a loan that's $1 million, $2 million, it is not easy to pay off. But if your loan is only a few hundred thousand, pretty easy. So think twice when you take a big loan. And with that, let's move on to point number 5, which is to have monies set aside for your dependents. Again, we are still in the quadrant of clearing liabilities. Make sure everybody around you is set up first. Then, you deserve financial independence and you deserve to pamper yourself with whatever surplus that you can derive. So this part relates to children and parents, which are the typical dependents that most of us have. For myself, my strategy is to contribute into CDA, Child Development Account, and I've actually pumped for my younger kid $30,000 even before he's entered childcare. That amount will get 2% interest, and in any case that his childcare does not exhaust the full amount, it becomes his PSEA account and eventually into his CPF if there's still a further surplus. If you have kids, I also suggest this. Set aside at least $50,000 as a pot to ensure that they have enough for future education. Once you have that pot, then you also can plan more for your own retirement. On the other hand, if you don't have kids but you have elderly parents you need to take care, ensure that you have set aside a buffer so that if they have medical needs or if they need your support in any case like renovating their old home, you have the capacity to do so. That is Filial Piety 101, something I believe in, and if you also believe in it, smash on the like button. With that, we'll move on to the next point, which is the top of the pyramid. Passive income. I guess you were waiting for this, and it is really a pyramid whereby you need to build the foundation solid. Your own health, sustainable insurance costs, clearing liabilities, then comes passive income. And within it, I have also 3 sub-points. And it starts with point number 6, which is have enough in your CPF for full retirement sum. Government has frequently measured the full retirement sum needs in accordance to lifestyle costs in Singapore. And right now, the full retirement sum is $192,000. And the plan is to escalate this at 3.5% per annum. I have a previous video on how much you need for full retirement sum. If you haven't seen it, check that out also. And the secret of doing so is to have enough already in your special account. Imagine this, you have $192,000 in your special account already. Then it compounds at 4% per annum, correct? It grows at 4%, the interest rate. But then the escalation is 3.5%, which means forever you have that full retirement sum intact already. And once you have that, you are safe. You can get ready to plan for cash flows that's before the age of 65, where CPF Life starts to pay. And that links to point number 7, which is to have passive income sources. There are a few simple ways to get passive income sources. The first is to have annuity plans. Check out this video which I've done previously, and I'll also leave towards the end of this, on leverage annuity plans. Leverage annuity plans are actually issued by almost all insurers, and right now many insurers can allow you to use it as collateral to get financing for it. And the key part is to ensure you're okay with the risk of interest rate, because this structure allows you to get cash flows out after a few years depending on plan, and it is just foolproof cash flows. You don't need to do any investment management. It's inside a participating plan by the insurer. But typically these plans require a few $100,000 worth of capital for the monthly amount to be sizable. But again, if you are serious about financial independence, you need big capitals. We're not talking about emergency cash of 20, 30,000. We're talking big sums of money that can bring you cash flows. That's why annuity plans make sense, and also a dividend portfolio. Think about this. What if you have a dividend portfolio that can be seen as a travel fund? If the dividend portfolio is 300,000 worth and pays 4% per annum, that means you have 12,000 annual dividends, correct? Which means also 1,000 per month. You can use that money for leisure or go for travel, because the beauty of financial independence retire early is time that you can use to see the world. And with that, it goes to point number 8, which is at the top of this pyramid that we have run through so far. And that is to have other income streams. In financial independence, you have free time, correct? That's the beauty of financial independence. You don't go working 9 to 5 already. But if you read around, many who are in that space are also not sitting around the beach doing nothing. That is actually quite sad. You get bored. You don't feel valuable. You don't have that drive that makes you happy. So what many have done when they reach financial independence is to have other side incomes. They take the chance to use that time to build side incomes for fun, with little pressure. They can start an e-commerce business. They can write a blog like Financial Samurai. They can do a YouTube like what I'm doing right now. And the beauty of it all is the future is a creator economy. That's why I chose to be a creator myself, to share openly with you my own financial journey. So if you benefited, again, smash the like button. And with that, I would like to invite you to leave any questions you have on this future creators economy. Everything that you have in terms of questions, financial independence, or my YouTube journey, leave them in the comment section, because I'll be doing a Ask Me Anything Q&A on the Josh Tan Show. This is the second channel that I have, and I want to do a live show to share with you more on a Q&A basis. So leave any questions you might have right now here. I'll pick it up and present to you on that channel. So with that, I'd like to say a big thank you to you for staying to here. And as always, stay safe, stay healthy, and I'll see you in the next video. Take care and goodbye.